It was another sell-off day on Wall Street with the S&P 500 down over 0.6%, so not a huge day. The Nasdaq was actually down worse, down 1.1%, largely as a result of some follow-through from Taiwan Semiconductor overnight in Asia, and then following through with a lot of the US-based semiconductor companies selling off today as well. We also saw some big selling in the financials today, but we did have some bright spots. We saw that the Reits bounced back a little bit, some of the consumer staples bounced back, and some of the healthcare companies bounced back as well. So it wasn't a complete washout day, but still it's the relentless selling that has been quite uncomfortable. Out of the last 21 days, only 5 of those days have been up days in the US market. So we did end with an oversold cluster signal yet again today, so maybe we do have a short-term rally on the horizon, but without a doubt the trends remain bearish. So we'll talk about all of that, talk about how that sets our posture. We'll also have a conversation about our trade application example where I wanted to focus on a neutral trade known as an iron condor on a fairly well-known healthcare company. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host Brandon Van Zee. It's October 11th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. And remember, at the bottom of those emails, you'll also find which stocks are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee, and if you're not doing so already, I would encourage you to follow me. We also really appreciate it when you click like and retweet on those Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us, and it was largely a lower day. Once again, there was some glimmer of hope in the middle of the day. We were kind of joking in my dividend growth investing class because in that particular class, we actually like to buy stocks when they're cheap and are on sale, and it just seems like more times than not, while we're in class, the market is up, and then it rolls over later on in the day, wouldn't you know? And once again, it happened here today. I don't know how many of you caught that Chiefs and Raiders game last night, but it was a great one. And, I saw the Raiders go up early. I said, do not count those Chiefs out. And that red color of the Chiefs helmet and uniform reminds me of the Bears. When we're in a more bearish trend like we've been here this year in 2022, you don't want to count them out. Even if it looks like they're down and out early in the session and the Bulls are going to win, it seems like the Bears come storming back time and time again. So here we are once again looking at a lot of red on our screen. I would say that the financials stand out to me as having consistent red there. Of course, that is an important area, especially this week. As I right-click and zoom into the financials here, you can see a lot of red on the screen there. Some of the insurance companies do stand out to the green side, and we talked about that quite a bit yesterday in my top-down trend trading class. But a lot of the traditional banks, unfortunately, are still struggling here. And just a friendly reminder, most of you probably aware of this, but as we kick off earnings season here later this week, it's usually the banks that lead us into that period of time. And so we'll hear a little bit more from Jamie Dimon and company when it comes to JP Morgan's earnings report here a little bit later. And of course, many of you might have heard that Jamie Dimon last night or yesterday at some point suggested that the U.S. economy will likely be in a recession in 6 to 9 months. And I don't think that's earth-shattering information. I think a lot of us probably feel like he's probably spot on by saying that. But it is somewhat noteworthy given his perch, being able to see, loans going out and the savings rates and different things like that. So wish I had better news to share with you on that front, but unfortunately this bearish trend in the stock market is kind of suggesting that the economy is coming next, and especially when you're starting to think about, the 7% mortgage rates and so many other concerns that we're dealing with inflation right now, that's going to start putting some significant pressure on consumers out there. And, it's going to be maybe a challenging period for a lot of folks to get through here in the next year or two. So brace yourself. In addition to the financials, you can see that there were also a lot of tech stocks that struggled today. That's been an interesting story this week as well, where we have a lot of semiconductor names popping up on the radar once again. Some of you might have heard that Taiwan Semiconductor was down significantly last night in the overseas markets, down somewhere between 5 and 10%, and so their ADRs here in the United States followed suit. But Taiwan Semiconductor is a huge company in the semiconductor space and does have a lot of influence. So you're seeing names like NVIDIA, Texas Instruments, Qualcomm, Intel, AMD, Broadcom, AMAT, Lam Research, KLA Corporation, etc. All of those semiconductor names, with the exception of Micron, they seem to buck the trend there. But for the most part, it did seem like what we saw in the overseas markets last night in Asia did carry through here to the United States with continued selling pressure within the semiconductors area. And that has been a house of pain this year, without a doubt. In terms of areas that did a little bit better on the green side of the equation, I'd probably throw healthcare in there. You can see it seems to me that more healthcare companies were up than down. I do see one bright one that catches my eye, in particular, Amgen. Many of you that have been with me throughout the years in my dividend growth investing classes know that Amgen has been kind of a go-to name for us over the last decade or so since they started paying a dividend. So it was good to see them at least having a nice day here today. You got to have a few winners here and there on occasion after such ugly selling recently. So happy to see them up. Also, Dividend Aristocrat AbbVie was up nicely today. Dividend Aristocrat Abbott Labs was up nicely today. Dividend Aristocrat Johnson & Johnson also up here today. So, a handful of those more high quality dividend growth types of companies doing a little bit better in the healthcare space. You can see Bristol Myers was up too. There's Cardinal Health, another aristocrat down there, a smaller player, but up over 2% today as well. So seemed like if there was a place to hide out today, it was largely in the healthcare area. You did see a little bit of a kind of a split difference there in the consumer staples space, maybe a slight tilt to the bulls here today. That area has been a little bit more roughed up here recently. A couple of those tobacco stocks have really been getting hurt. Philip Morris International, Altria, both up somewhat nicely here today. We actually had a good head-to-head matchup in my options for long-term investors class yesterday afternoon between Procter & Gamble and Coca-Cola, now that they're starting to approach the blue zone of the dividend stair-step charts. They're not quite there yet, but we looked at a couple of options yesterday where we could sell puts that would put our starting cost basis in the blue zone. So even some of the highest quality companies out there are starting to feel the selling pressure here recently with those usually big, slow-moving, boring bellwether dividend growth stocks like Procter and Coca-Cola even starting to suffer a bit. But today they popped back just a little bit there, as did Walmart. And Kroger had a pretty nice day as well. I do see some green kind of creeping in there with the real estate area. I remember we've been talking a little bit more about the Reits, mostly because of how ugly things have gotten so quickly in that particular area in the last, let's call it, month or so. They have just been absolutely falling off of a cliff, and so it's good to see them kind of popping back largely here today. Not all of them, but a big chunk of them were up today. I'd also throw energy in there for discussion because they were largely lower here today. That's been an area that's held up a little bit better than others, but today just wasn't their day. Some of those names like Occidental, of course, big Berkshire Hathaway name there, down 2.5%, and even the giants like your Exxon Mobil's and Chevron's down just a touch here today. Would also throw out the industrials for consideration, particularly the aerospace and defense names. Notice that Raytheon was up today. Lockheed Martin was up today. Northrop Grumman was up today. General Dynamics was up today. L3 Harris was up today. All of those are defense contractors for the U.S. government and the allies. And of course, when we're in a more tense environment where there's a lot of saber rattling going on with not only Russia, Ukraine, but of course we've been hearing what's been going on with North Korea lately as well with some of their missile launches. So maybe one of those areas that can buck the trend in the somewhat cyclical industrials sector could be an area that doesn't require a strong economy to be boosted. Instead, it depends upon strong government spending, particularly on military, and we do still have that here in this country. Notice that Netflix really struggled here today, down about 7%. I also see Las Vegas Sands popping up there with a very bright red box there, down 7% as well. That casino area has been really interesting. We've been talking a little bit more about them, it seems like, when I've been reviewing these heat maps with you guys in recent weeks. For a while there, they were always popping up on the green side, but it seems like the last few times they've been popping up back on the red side. So it seems like those casinos are just a little bit more aggressive here recently. And unfortunately, that's not working out so hot for our DraftKings bullish trade that we did some time back. We were in the driver's seat with that for quite some time, but with the sell-off in the casinos here in the last week or so, even that one has started to struggle alongside some of my other bullish trades, like some of the sold put trades that I've been doing. And by the way, I have done 3 different rolls on my sold put trades here in the last couple of days. And remember, one of the big benefits that our premium members get at Market Scholars is access to our private Telegram channel, so that way they can be alerted as soon as I make any sort of maintenance decisions on my trades, whether it's for this market outlook presentation or for the 4 different trading rooms I'm teaching my premium members. And the same thing goes for David's trade. So that's a nice perk that many of you premium members will receive if you wanted to keep up with our trades, not just learn when we're putting them on, but also how are we managing those trades can be equally as important to a lot of you. All right, let's go ahead and now take a peek here at our breadth numbers. I've got the S&P 500 pulled up here, and as you can see, 199 out of 500 closed in the green today. So that was good for approximately a 40% hit rate for the bulls, which was actually a little bit surprising to me. Maybe I was in the wrong stocks, but it kind of felt a little worse to me today than that type of a split decision. It wasn't exactly an equal split between bulls and bears, but if I would have guessed ahead of time, I would have probably pegged the winners at maybe 25 to 30%, but it was actually a full 40% of the market was higher today. So if you were in the right areas, like I mentioned, the healthcare area seemed to stand out pretty nicely, along with maybe some consumer staples and Reits and things like that. But it wasn't a complete washout day to day, so I guess we should be thankful for that. We've had plenty of those 90% down types of days where most stocks are lower. Today was not one of those. Yes, the bears did control the price activity, but it wasn't terrible like we've seen in other instances. Let's go ahead and now take a peek at our 4 grid. And as you can see here, we've got chart 4B pulled up here in front of us, and you'll notice that we are looking at the 4 different major U.S. equity indices. And, in this particular case, I would mention that 2 of them are showing up with these kind of light pink tags on the chart. Notice that is the S&P 500, and that is the Nasdaq Composite directly below it, and both of those light pink tags say yearly low today. If you want to be bullish in the markets, you do not want to see those tags. It is telling you that on an intraday basis, and probably on a closing basis as well, we hit yet another 52-week low. And remember, the S&P 500 is largely viewed as the most important equity index, not only in the United States, but you could probably get away with saying it's the most important equity index in the world. So, if we had to pick and choose which index we could either see that tag on or not, I don't think many of us would want to see it on the S&P 500, yet that is the truth. Don't shoot the messenger. It is what it is. We know that we are in a bearish trend right now. The question is, when will we get some reversion to the mean? We thought maybe there was a glimmer of hope last week with that back-to-back rally. I talked about it because I was with you that Tuesday afternoon right there. And I was still kind of pointing out the fact that we still had an air pocket between where it was that Tuesday and the downward trending 30-day moving average. And then I was with you again 2 days later on Thursday of last week. And that was the day that the intermediate posture, according to the market forecast, switched from bearish to weekly bullish. But I encouraged you to not read too much into that, and I told you that I myself was still quite cautious and hesitant towards that, because when we're in a market environment like 2022, you're going to have head fakes that take place. But the onus is on the bulls to take control of the market. The onus is not on the bears. The bears already have the ball. It's a matter of whether the bulls can get the ball back from the bears. And you probably shouldn't trust the bulls to do that when the bearish trends are in place. So despite the posture changing according to the market forecast, because we had that green line pop out of that lower reversal zone, I was telling you that I would not personally trust the bullish move until we spent considerable time above that 30-day moving average at a minimum. And we haven't even touched the moving average, let alone spent any time above it. The last time we touched it was back here on September 12th. And of course, you know what happened that day. You kissed it, and it immediately was used as resistance the very next day with a gap down. So this is not a healthy market environment that we find ourselves in right now, especially if you're a trader. Obviously, if you're a long-term investor, you might find a few opportunities that you like at attractive valuations. But if you're trying to trade this market, clearly it is still favoring bearish trades over bullish trades. And of course, you don't need me to tell you that. But I did want to point that out because we'll have other instances like that in the future as well. Remember, if we are indeed heading into a bear market, we could very well be in one already. Most bear markets do not claim their prior high until 3 years. That's the average, right? From high down to low, back up to breaching that prior all-time high. The average time period is 3 years. So for some of you, this might be your first rodeo when it comes to dealing with bearish market conditions. After all, since 2008 and 2009, it's been pretty easy. You've had a couple of, sketchier moments here and there when we lost the, AAA credit status in the United States back in 2011. That was a sketchier moment. We had a late sell-off in 2018. That was a sketchier moment. And then, of course, COVID was a sketchier moment. But there hasn't been a prolonged bear market since 08-09. And so for some of you, this could be the first time you're ever approaching that. And, like we were saying here earlier today, kind of feels like death by 1,000 paper cuts, right? It doesn't feel very good. You get glimmers of hope here or there, but usually those glimmers of hope are rapidly flushed away. And that's exactly what we saw last week. We had this amazing 2-day rally, and remember the statistics were real. They were factual. We're talking about how the 2-day rally was the best 2-day rally that we had in over 2 years. We also talked about the fact that most of the time when you get that kind of aggressive movement, it's happening within the perspective or context of a downtrend, and you just had too aggressive of selling to snap back to give you that type of a rally. And here we are just 1 week later, the entire effects of that, once every 2 year type of 2-day rally is completely gone. We are back right now, 1 week later, to below we were before that epic 2-day rally even started. So my oh my, how quickly they can wipe away the optimism when we're in these bearish types of market environments. So I guess if there was any good news, the good news is this: we're back to oversold cluster again. Now, I'll remind you that we had 5 oversold cluster signals in a row during this 5-day period from September 21st to September 27th. So just because we have another oversold cluster signal here again doesn't mean that this has to be the low. This could be the first of 5 more cluster signals. Who knows? What we know is sentiment is horrible, right? I don't think there's a whole lot of bulls left out there that are, screaming from the mountaintop that, this is a wonderful market. It seems like if there's any sort of loud conversations that are taking place within the markets, it's the bears that are controlling the conversation. Like I mentioned before with Jamie Dimon saying that, hey, we're going into a recession within the next 6 to 9 months. It seems like more of the conversation is leaning more bearishly right now. And even if you look at some of the sentiment indicators out there, like the AAII polls that come out every month, it does seem like most market participants are quite bearish right now. And that might actually work in the favor of the markets. Whether that's the type of thing that can carry you to a trend-changing type of a market is what is to be debated. But in the short term, it does feel like we are due for some sort of a market rally. But it doesn't mean that it has to start today. What if it starts after another 5% sell-off from here, right? But it is true that things feel really lousy out there. They feel terrible. Anytime you try to get bullish, the market just knocks you across the head and reminds you not to make that mistake too often. So when you're in that type of market environment, at least there are some seeds of hope that the pessimism is so strong right now that the market makers might do their best to frustrate the biggest part of the market and whip it back the opposite direction. But again, if we get back up here to this falling 30-day moving average, I would suggest caution. Until we can see the market prove it to us, we should not trust this market. Even if it looks really good for 2 days in a row like we saw back here, or 4 days in a row like we saw back here to get to the moving average. Let's say that happens again starting tomorrow, because who knows? We don't know when that's going to occur. But there's a decent chance that there's a reversion to the mean move on the horizon at some point. And let's say it starts tomorrow and we have another 4-day rally right back up to that falling 30-day moving average like we did back there. I would suggest that that's probably a time to consider lightening up on your bullish positions if you're a trader, or even enacting more bearish trades at that point. And that would be right around 3,800, maybe a touch above that. But point being, this is still a downtrending 30-day moving average that has been used as resistance in the past. And although we're going into a more bullish time of the year seasonally, once we get to November, remember, there's still a few weeks left of October, and a lot of bear market crashes have happened in the month of October. So the market will kind of remember that, and some of this will be dictated by whatever inflation numbers are going to be coming out, whether that's this week or through the conversations that we'll start having with the earnings announcements, right? We'll have the banks kicking us off later this week, but then we're going to have hundreds, if not thousands, of companies reporting their third quarter earnings announcements within just the next 3 or 4 weeks. And many of those CEOs and CFOs in the conference calls are going to be talking about the impact of inflation on individual businesses. Maybe we're all thinking about this too hard. Maybe inflation will come in. But right now, we're not getting any help from the Fed, right? That's a conversation we were having in my class today as well. Talking about all the pain that investors have been feeling so far in 2022. And a lot of times in the past, when investors have started to feel intense pain from their portfolios, the Fed has been there to bail out those investors by starting to become more dovish and start talking about lowering interest rates and stimulus packages and this, that, and the other thing. Well, guess what? It's the exact opposite of what we're dealing with right now. We have a Fed that is going out of its way to tell anybody who's willing to listen just how hawkish they are right now and how hawkish they want to continue to be in the immediate future in order to squash inflation. So that is a challenge here as well. It kind of gives you the impression that if we are indeed in a bearish market, or a bear market right now, a prolonged bear market, it doesn't really give you the sense that we're even at the halfway mark yet. And that's a scary thought for a lot of people that have already lost substantial amounts of money in the stock market. Remember, especially a lot of those, innovative and disruptive types of companies in the ARK investment funds and all those types of companies. Several of those are down 70, 80, 90%. It just feels like death on a lot of those companies. Yet from the overall market's perspective, we could still have a long journey in front of us for the next year plus with more bearish types of conditions. I personally hope it doesn't get as bad as it did in 2008 and 2009 when the market was down over 50% from its highs, because that was an extreme, hopefully once in a generation type of a situation we were dealing with there, with a potential collapse of our entire economic system as we know it. Luckily, that didn't happen. So I don't necessarily think that the future year and a half or so is going to be nearly as devastating as that 08-09, but even if the market is down 35 to 45% and doesn't quite get to the 50% down, that's still going to feel extremely painful to people who are already in pain right now with the market only down 25%. So we'll all find out together what kind of a bear market we have in front of us, but as each and every day moves along, it's becoming clearer and clearer that the economy is going to have some struggles in the future, and that earnings will probably need to be ratcheted down. Earnings expectations for the future will need to be ratcheted down as a result of inflation, as a result of an expected recession, as a result of consumers pulling in their horns, realizing they can't afford $1,000 car payments every single month. They can't afford $2,500 mortgage payments every single month with mortgage rates up at 7% these days. So a lot of consumers think they can handle that right now because they've got a job. But when we head into a recession, remember, a lot of jobs will go away. And once they're stuck with all these monthly bills that they could just barely afford when they were gainfully employed, they're going to cut back and perhaps, make some tough choices in their life at that moment. And that's going to wreck a lot of areas of economic activity. So again, I hate being the bearer of bad news, but it's the truth of what appears to be taking place before us, right? And we have to be pragmatic in this business. We have to be honest with what we see. And unfortunately, it's looking quite bearish out there, just like it has for quite some time. As you can see with these charts, most of them have been in this pink zone here for the better part of the last month and a half. So this shouldn't come as new information to us. So again, let's be on the lookout for a reversion to the mean type of a move. We're overdue for some sort of more sustained bullish activity more than just 2 days. But as we start running into resistance a little bit higher up, you will have to start questioning whether you want to kind of endure the possibility of more market pain in the coming year or so, or perhaps reposition yourself to maybe hedge yourself a little bit more or add more bearish trades or what have you, because it is tough sledding out there right now. So anyway, S&P 500 was down 0.65% today. Nasdaq Composite, where you find all those semiconductor companies and other, more speculative types of tech stocks, it was down 1.1% today. Clearly the laggard of the market, and it also has an oversold cluster signal. In fact, second straight day for the Nasdaq. Similar to the S&P 500, the Nasdaq is now down 5 days in a row ever since that really nice 2-day rally. Now let's talk about slightly better conditions, although not necessarily anything we want to get overly excited about. But hey, credit where credit is due. The Dow Jones Industrial Average and the Russell 2000 actually closed in the green today. How about that? Dow Jones was up a whopping 0.12%, and the Russell 2000 was up a whopping 0.06%. So in other words, barely up, but yet still closing higher is much better than the 1% meltdown or sell-off that was experienced in the Nasdaq. And remember what I mentioned to you guys last week when we talked about the Russell 2000 at that time. It probably would have been in my Thursday presentation. To me, it looks like the Russell 2000 is handling this moment in time better than these other areas. And so if you're looking for relative strength, it seems like the Russell 2000 has more relative strength than these other 3 large cap indices. And remember what we talked about at that time. We talked about reading the green line and the absolute number of it. It's at 22 right now versus 19 on the Dow versus 15 on the S&P 500 and versus 12 on the Nasdaq Composite. So with the highest green line or intermediate line reading, it's telling you that it's holding in there a little bit better. I also talked about how it was closer to its moving average on Thursday than what we saw out of the other indices as well, and that's probably still largely true. And the other thing that I would point out is while the S&P 500 and Nasdaq Composite hit yearly lows today, remember the Russell 2000 hasn't for quite a few months. So these charts by default are just 3-month, 1-day charts. But if I were to change this from 3-month to 6-month, you can see that the low that was put in on the Russell 2000 was way back here on June 16th. So even during this really big sell-off that all the indices experienced here about a month ago, where we had all those oversold cluster signals in a row, the Russell 2000 did not breach that prior low, whereas the other indices did. So, that's another way to identify that if you're looking for relative strength, you're finding it a little bit more so in the Russell 2000 right now. But even that, you've got to be careful taking it too far, because just because something has relative strength does not mean that it's going to lead to absolute gains for you. You're still fighting against the trend of the market, whether it's relative strength or not. The trend of the Russell 2000, just like these other large cap indices, is still to the downside. But it's just that if we do have some sort of a temperature change in the market, let's say a lot of companies come out and really surprise to the upside with really good earnings reports, and the market does really start taking off here. Even though it doesn't look like that's a possibility right now, remember, anything's possible. So if that were to occur, then you might be wondering, well, which areas are more likely than not to outperform? And typically you find the areas that withstood the storm of the selling better to be the new leadership group moving forward. So if we wake up, a month or two from right now, and these indices are actually acting much more bullishly than what appears to be the case right now, we could very well see that it's the Russell 2000 leading the way during that time period. And of course, if that's the case, you want to know that in advance, which is why we are talking about it right now. So that way you can kind of put a pin in that in the back of your mind in case you want to take a bullish flyer here or there on a small cap stock. Maybe that's the area of interest for the market as we move forward. By the way, the Dow is now back to what we would call a strongly bearish posture, as is the Russell 2000. So let me go back to a 3-month chart here, so that way we can be consistent with all of these. So again, that was quick. In other words, this quick little 2-day rally that all of the indices experienced last Monday and Tuesday has been completely unwound, and all 4 of our charts are back to strongly bearish postures. But because the Dow and the Russell 2000 managed to close barely in the green today, that prevented them from having an oversold cluster signal the way that we do have with the S&P 500 and the Nasdaq Composite today. But remember, if tomorrow's a sell-off day in the market, once again, there's a decent chance we could get there with oversold cluster signals on the Dow and on the Russell 2000 as well, because you'll notice that the green line is just barely outside of the 20 zone on the Russell 2000. It's at 22, and it's actually underneath 20 for the Dow, but in that case, the blue line was just barely above that 20 zone. Remember, for a cluster signal, you need all of those colors, the main ones at least, the red, the blue, and the green lines to be below 20 on the same day. So with the S&P 500 and Nasdaq, it achieved that. The Dow was almost there today, but had its blue line barely above 20. And then the Russell 2000 was a little bit different, where both its blue line, its intermediate green line, and its red momentum line, for that matter, were all just a hair above 20. So point being, they're all very close to it. And if we had a big sell-off day in the market tomorrow, we could be looking at clusters at that time across the board. So let's keep our eye on the ball there. And again, take a look at how much selling there's been here recently. This is ridiculous amounts of selling in the S&P 500. Remember, whenever you have a red outline, that is a sell-off day. So even that candle right there on the 5th of October was a down day for the market. So if I right-click and maximize that, you can see that here recently we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 sell-off days. And intermingled within those 16 sell-off days, we've had just 1, 2, 3, 4, 5 up days. That is crazy. Usually in normal market conditions, it's the opposite, right? Stocks tend to go up more often than they go down. So that again just goes to show you how difficult of an environment we are operating in right now. Out of the last 21 trading days, 16 of them have been sell-off days, and only 5 of them have been up days. Yikes. All right. With that bit of good news, and of course I'm being sarcastic and just kidding there, we've got to have a light sense of humor here because, boy, how else are we going to get through these awful conditions if we can't rely upon our humor? But with that wonderful note, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this free Market Outlook video that you can find on YouTube, or you can also find it here directly on our website. Remember, if you come to the Market Scholars website and come over here to this Market Outlook tab, you can watch the videos directly on our website. And as I always say, as long as we're up and over 100 likes when I'm doing the video on Twitter, I'm more than happy to give you a full-length video the next time I'm scheduled to do that. And as you can see, 112 of you clicked like for me the last time around. So easily up there into those triple digits, and I really do appreciate that. You guys are amazing. Please keep up that work, assuming you want to have these longer form videos. Now, I don't make that assumption because some of you probably prefer the much shorter version, and therefore if you like the 15-minute version of the video instead, if you just kind of want to get on with your day with a quick recap of the market, then don't click like for me there on Twitter. On the other hand, if you enjoy the extra analysis and our additional thoughts that go into the 12 grid charts and what comes about with the trade application example, then I just ask one simple request out of you. Take 5 seconds out of your day and click like for me there on Twitter. Remember, you can do that directly here on our Twitter widget below where you're watching the video on our website. Otherwise, you can, of course, go directly to Twitter, look me up at Brandon Van Zee, and it'll be pinned to the top of my timeline. You can also find the tweet in question in the description area of the YouTube video for those of you that watch this directly on YouTube. And then one last place you can find the tweet in question is by looking at the Twitter icon on the email we send you at the bottom of those emails. So however you choose of those 4 different possibilities, they all get tallied up in the same area. And again, as long as we're up and over 100, then I think it's worth my while to take the 3 hours out of my day to do this video. If we're under 100 likes, then I get the impression that these videos aren't quite as worthwhile to you, and that's okay as well. I can save my time the next time I'm scheduled to do the video. So we'll let you guys decide collectively, but as always, thank you, thank you, thank you. You guys have done an amazing job helping support these videos, and that means a lot to David and I. As I mentioned before, I taught my dividend growth investing class earlier today, so if you're a premium or a plus member, you can access that here in the trading rooms area. And we did concentrate on the utilities sector in our head-to-head matchup for dividend growth investing here today. And then David taught his directional option strategies class that you can check out the recording of as well. Tomorrow, I've got factor-based swing trading at 11 a.m. Eastern Time, and then David's got options inventory trading at 2 p.m. Eastern Time. So lots of great stuff heading your way as always. Also, let's have a little chat here about the sector selector tool. Now remember, I put this together on Friday evenings once I've got all of the weekly statistics squared away. So it is a couple of days stale by this point, but still gives us a pretty good idea of what's been taking place underneath the surface of the market from a sector perspective. One of the bigger things, and I shared this with you last week as well, so it won't be a huge surprise if you listened to my presentation last week, but it continues to be the case. Look at the big sell-off in utilities, or at least on a relative basis, they are not performing nearly as well as they were just a month ago. And by the way, I just mentioned a moment ago, we talked about the utilities sector in my DGI class. And like I was telling that class today, remember the sector selector is built for my Monday top-down trend trading class where we focus on relative strength purely through price action of sectors and stocks and industries. And so if you're a dividend growth investor, oftentimes you are going to look at this 180 degrees differently. Because if this is telling us what's happening with price, then of course when you're a dividend growth investor, you might actually prefer the sectors that are at the bottom because the harder that they sell off in price, the bigger their dividend yields become. And so interestingly enough, earlier in this semester's portfolio, because we take a 6-month period of time to build out a DGI portfolio during my classes, and earlier this semester, I was telling the students that I had anticipated that this would be a semester where we have a lack of exposure to utilities because their price was too strong, and I wasn't seeing enough good value out there to have the utilities become a larger component of that DGI portfolio. But my oh my, how things can change very, very rapidly with how aggressively the utilities and REITs have both sold off here in just the last month. Both of those areas could very well become larger than average components within our finalized DGI portfolio by the time we wrap it up at the end of December. So it is very interesting to kind of witness what's taken place because there has been some very large movements from a sector perspective. If you're a trader looking for relative strength, the areas that are starting to perk up are energy, industrials, consumer discretionary, financials. If you're more of a dividend growth investor where you're looking for those areas that have been bombed out in price with their dividend yields going up to be more attractive from that perspective, then the areas at the bottom, materials, communications, utilities, and REITs might get you down there. All right, let's go ahead and get back on over to the main part of the platform now and have some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And a reminder that when this gets pulled up here, the background colors of these 12 grid charts will be either pink or green, and there's 2 shades of each color, either a light or a dark, depending upon whether the posture is strong or weak. And the pink charts are bearish postures, and you can see most of them at the top are strongly bearish with that dark pink, but we do have gold down below with light pink, suggesting that that is just simply a weakly bearish posture. Then we do have 3 green charts on the board as well, all on the bottom rung. They're all dark green, telling us that we have strongly bullish postures according to the market forecast technical indicator, right? That's not just me or David making that up. This is driven by the market forecast technical indicator. And remember, if you are a premium member that has access to all 50 plus of our customized charts, you can right-click on these miniature 12 grid charts and actually see down below. So like if we were to go into gold right here, if I right-click on gold and then go to maximize sell, you can see the market forecast technical indicator down below there, and it's the green intermediate line that drives the posture mechanism of the background colors up above. So when this green line rolled over last week on GLD, that background color started changing to light pink. And so you guys have heard me talk about the corners, the bottom corners of this chart quite often in 2022. I wish it wasn't the case because unfortunately what we've discovered is the bottom corners have been bullish much more often than they've been bearish throughout this calendar year, and that has spelled disaster for the rest of the stock market. Those 2 bottom corners are once again the US dollar in the lower left and the 10-year Treasury yield in the lower right. And those 2 areas are kind of being driven by some of the same themes, but it's largely inflationary pressures and also more of a defensive risk-off type of a market environment that are kind of driving those areas right now. And unfortunately, those are the market conditions that stock market participants do not appreciate. So once again, we're back to strongly bullish posture on the US dollar. It was up for what appears to be its 5th straight day. So remember how the S&P 500 has been down 5 days in a row? The US dollar has been up 5 days in a row, and I do not think that's a coincidence. You could say the same thing here for the 10-year Treasury yield. It is also up 5 days in a row, while the S&P 500 is down 5 days in a row. Again, I do not believe that is a coincidence. There is a reason that macroeconomic activity has the correlations that it does. And so right now the market knows that its stress point is what is going on with the Fed. And with the Fed committed to squashing inflation, it is more likely than not to send interest rates higher, at least in the short term, and try to stamp out that inflation. And unfortunately, the stock market doesn't like that. And nor should it, right? The idea of higher interest rates for consumers tends to mean lower profits for corporations. and pulling back of the horns, as I mentioned before, on economic activity. So unfortunately, until we start to see a rollover on the 10-year U.S. Treasury yield, it's going to be a hard time for the U.S. stock market to stabilize. Who knows? Maybe it's going to be, something that can happen. A lot of things can change. We have to remind ourselves that the markets are highly variable. News stories can impact things. But right now, I think that's the key to the market. The Treasury yield keeps on going up. The stock market is going to have a heck of a hard time rebounding. If the Treasury yield rolls over, it's an impression that maybe the Fed will start getting a little bit more dovish, then maybe the stock market can rally. But I don't think we're really that close to that, at this moment in time, at least for a big trend-changing type of a move. Again, we're overdue for some sort of a short-term reversion to the mean type of a move. But what I'm referring to as a sustained bullish move likely is not going to be possible until interest rates roll over consistently. And we're just not in that environment right now. Interest rates tend to go up. And I venture to guess that most of the last 21 days, when we were counting out all the sell-off days in the market, I would venture to guess that most of those 21 days, the 10-year Treasury yield was up more often than it was down during that time period. So to me, that's the key of the market. And right now, I don't have a whole lot of good news to share from that point, unless we start seeing some of those inflation numbers really cool off in a major, major way to give the impression that the Fed can start kind of holding off on its expected rate hikes. But I just don't get the impression that's going to happen. So I hope I'm wrong about that. But that's the way I see it. Anyway, oil is kind of the outlier there, where it is with a bullish posture as well. Remember, earlier this year, more times than not, it seemed like we had those two bottom corners green, but everything else pink. Today, we also get oil with the green background color. But if we were to maximize that sell, you can see that with this two-day rollover here in oil prices, it was down about 3% today. You could see this green line roll over if you get another day or two of selling there. So this is pretty precarious bullish posture right now that could easily go away within just a day or two. Whether it does or not, anybody's guess. Remember, oil is a little bit of a strange animal because it is so driven by news. And of course, like I mentioned before, all the geopolitical news, Russia, Ukraine, North Korea, a lot of saber rattling going on out there. That might put a little bit of a bid underneath oil prices compared to other commodities that are out there. But even that has its limits if there's not any sort of associated nervousness with the news out there. If the dollar remains strong, all else being equal, commodities tend to be weaker. And while oil has done a good job kind of bucking that relationship more times than not this year, at some point you've got to figure that's got to give. Because remember, oil prices are driven by strong economies for the most part. And if the economy here in the United States especially is about to get weak and go into a recession in 6 to 9 months, like Jamie Dimon suggests, then that means that there's going to be less fuel used in all likelihood, whether it's in your own car because you're not driving to work anymore because you might not have a job anymore, or whether it's because you just simply don't have the discretionary money to spend on going and traveling across the country the way that you would if you were flush with cash, and a lot of other uses as well, of course. But a lot of times fuel, gas, all that kind of stuff is driven by strong economic conditions. And if we're heading for the opposite of that in the future, you might get away with suggesting that oil prices will start pulling in their horns here sooner rather than later as well. In terms of some of these other pink charts up above, not a whole lot of positive news I can share with you. Lots of selling there, and it feels like the selling has been pretty relentless day after day after day. Notice that we did have today the foreign stock markets do even worse than the United States. Both EFA, which is the developed foreign stocks, and EEM, which is the emerging foreign stocks, were down well in excess of 1%, whereas the U.S. Market was down less than 1%. And remember, when the U.S. dollar is strong, all else being equal, you should expect foreign markets to struggle more than U.S. markets. And we did see that relationship play out today in both the stock market and the bond market. Notice that the foreign bonds were down 0.42% today, whereas high-yield bonds in the U.S. and TLT US government bonds were both up today, believe it or not. I actually rolled the TLT sold puts that I had done before, as some of you might have seen in the Telegram channel. But it has been a house of pain for TLT. It just keeps on plunging to greater depths, and we are still, even after today's rally, below 100 on TLT. And if you would have said that to folks at the beginning of the year, they probably would have laughed you out of the building. But that's what has made 2022 so darn unique. Not only has the stock market gotten absolutely annihilated, but the bond market has been equally as decimated. And usually you do not see those two things happening in conjunction with one another. In fact, the 60-40 portfolio is currently in the midst of its worst year in my lifetime. Not to give away my age or anything, but I'm a late 70s guy when I was born. And the last time we had a year this bad for the 60-40 portfolio was in the mid-70s. And so, we're talking about 4 to 5 decades ago since we saw anything that resembled what we are all going through right here in 2022. It's been awful, whether you're looking in the bond market or in the stock market. And quite frankly, it's not like it's been a walk in the park for commodities either. So, you're lucky if you're hedging yourself or doing inverse funds or taking bearish trades or doing things like that. But otherwise, if you're trying to go long securities, whether it's fixed income, whether it's equities, whether it's currencies in many cases other than the US dollar, whether it's commodities, it's been a struggle this year for sure. Let's take a look at what's going on with the sectors here in the United States now. This will be chart 5C. And so as you can see, we just have one green chart left on the board, and that is energy. Energy was actually down today, as I alluded to when we were looking at the heat map earlier. So despite it being down 3 days in a row, because energy was up so much during that week and a half stretch right there after having its oversold cluster signals, it's still clinging to a bullish posture. But if we right click on it, go to maximize the sell, you can see this is very precarious, even more so than oil itself. Remember, we just talked a second ago about oil prices and their bullish posture and how it could change to a bearish posture within a day or two. This looks even more precarious because if you look at this with just your eye, this green line looks flat from yesterday to today. So even if there's just a tiny sell-off tomorrow in XLE, there's a good chance that this background color will change to pink as soon as tomorrow. Now, if it's up a bunch, then all bets are off. But point being, you had some, good activity, some good bullish activity with that green line rising out of the ashes there when we had this big move higher. But with this 3-day sell-off we've had, you've basically stretched this to now flatline. And if it just dips even a little bit tomorrow, you go to a pink background color there at that time. So tomorrow, we could be in a position when David does this video for you tomorrow night where we could have a clean sweep across the board of bearish charts. Now, it would just be weekly bearish, so it'd be a light pink color, and that would still make it different than the rest of them, but just goes to show you how intense the selling has been lately, where your sector charts show you that there's really no place to hide. You're selling off across the board here, at least from an intermediate perspective. Again, today you had a few bright spots here and there. Staples were up 0.82%, healthcare was up 0.53%, and real estate was up 0.94%. Remember, those were the 3 areas I specifically pointed out on the heat map, and I did not cheat and look at this ahead of time, so I'm glad to see that my hunch was correct in this case. Those were the areas that managed to close in the green today. But the point is, does it matter, right? These things are in such significant downtrends, especially staples and real estate, that, yeah, big whoop. You got it 1 day of an up move. Who really cares in the grand scheme of things? Healthcare, I'd say, is holding up a little bit better than those other two, but those other two have a lot of work to do, especially real estate. You heard me talking earlier about how utilities and real estate have fallen off the cliff in the last month. This is what I'm talking about. Look at how steep that descent is on utilities. Same thing goes for real estate. You don't really see that out of these other sectors. The other sectors might be drifting lower, but this is like falling off of a cliff type of a move with utilities and REITs. Remember, those are the two most interest rate sensitive areas. So it feels to me like the market got extremely concerned about rising rates, especially in the last month and a half, and has reacted in kind by selling off utilities and REITs. But, if you're a long-term investor like we were today in my dividend growth investing class, you look at this for the opportunity that presents itself with. Are there some utilities out there that have a long track record of raising dividends that are now priced at more appropriate levels today with much higher dividend yields than they were just a month and a half ago when their prices were much higher and their yields were much lower? So, it depends on who you are. Most of you that watch this video, I'd have to believe, are more trader-oriented, short-term oriented. So that's, where our analysis leans. But remember, if you are a long-term investor, we do have 8 different trading rooms we teach you every week here at Market Scholars, one of them being the dividend growth investing class, where we tend to think outside the box. We're kind of counter trend, I guess you could say. When things sell off aggressively, we look for the opportunity that exists there. So a pretty good quote from, I think it was Brian Feraldi on Twitter today that I retweeted, that said that, where most people lose the most money is by buying low quality stocks when times are good. And for those of you that have been in my dividend growth investing classes over the last decade, you'll know that my battle cry in that class is buy high quality merchandise on the cheap. So it's kind of the opposite of that. In other words, we're looking for the best businesses on the planet, and we're looking to buy them when they are out of favor, not when everybody else loves them. When everybody else hates them usually is the time when they offer the most attractive our most attractive opportunity moving forward, right? Yes, we can all see that they're down recently. That's hindsight. That's 2020 hindsight looking in the rearview mirror. But what we don't know is what happens in the future. But what I do know factually is I'd rather buy the utilities down here than buying them up here if I'm a long-term investor, because my upside potential is much greater with more appropriate valuations down below. So I think it's important to remind ourselves of that as well. But for the most part, it is pretty ugly out there. You can see that we've got not only a cluster on the S&P 500 itself, but we've got a cluster on communications today. We've got a cluster on technology today with that sell-off in the semiconductors. We've got a cluster on discretionary today. We've got a cluster on utilities today. So it's pretty bleak out there. We're due for some sort of a reversion to the mean rally here, hopefully sooner rather than later. All right, let's talk about our trade application example. And I'm just going to pull up chart 3A for this. And remember, the trade was done while the market was open. We always send out our telegram, so that way you guys that are our premium members can consider the trade before all the free people that watch it on the YouTube video later that night. So Gilead is the stock that I chose. Now, initially, I was looking for a bullish trade idea out of this, but I couldn't get filled at the price that I wanted to when trying to set up a bull put spread on it. So instead, what I opted to do was set up an iron condor. And you see 2 different lines on this chart. You've got a top line that is at $70.75. You've got a bottom line that is down here at $59.25. When you sell an iron condor, what you're doing is you're selling a bull put spread on the bottom side and you're selling a bear call spread on the top side. And what you want out of that type of a trade is for the stock to stay in between those 2 levels for now until expiration day. Now, the securities that I selected were in the month of November, and some of you will see that we do have an earnings announcement coming up. So this may not be a great trade idea for all of you. I will warn you that if you don't like to trade through an earnings announcement, then you just disregard this trade. There's nothing wrong with that. But hopefully part of the juice that we got when we sold the credits here today were as a direct result of the market knowing that earnings were coming up as well, and we probably got more credit than we deserved. I think our return on risk on this particular trade was like 42 or 43% or something like that, so a little bit higher than we would normally shoot for. But you can see that what I've done is I've selected the $70 strike to sell on the top side from the call perspective, and I guess it would be the $60 strike on the downside put to sell. But with the credits baked in, that pushes them a little bit further up and a little bit further down, and you can see that as long as Gilead stays in the exact same range that it has been for the last 3 months, then that will still be an acceptable trade idea. If it breaks down below the lows that it set back here in August, or if it breaks well above the highs that it set in the middle of September, then this trade could get into trouble. But otherwise, if this stock just keeps on doing what it's been doing for the last 3 months while we've been in market conditions, generally speaking, that have been quite volatile, this one really hasn't been that volatile. And if it continues to do that, through November expiration period, then this might be a trade that can make some money there. So that's the trade idea for the day. An iron condor there on Gilead due to its sideways price activity over recent months, with the hope that that continues in the next month or so. So that's what I had for you here tonight. I hope you enjoyed the video. If you did, I have one simple request. Simply click like for me there on Twitter. As long as we're up and over 100 likes, by the time I'm scheduled to do the video again on Thursday, I'll plan on doing another full-length video like this one. If we're under 100 likes, then I'll just stick to a quick little 15-minute index-only review for you guys. So I'll let you guys decide collectively. Regardless, I do appreciate you guys checking out tonight's video. Best of luck with your trades and your investments. Goodbye for now.